Everyone, welcome to YX Insights. This is Yimin. We're going to do a market update today ahead of the market open. Today is October 25th, 2024. And we're going to first walk through some liquidity analysis and the Fed rate cut pricing. And then we're going to do our live market, our technical analysis on SPY, QQQ, TLT, Tesla, the other Magnificent Seven stocks and the mega caps, and as well as the setups we have that are still live today. So let's just begin with the Fed liquidity analysis. So just to recap, the red line here is a measure of the Fed liquidity. It consists of the Fed's balance sheet, less the Treasury General account, which is the US government's bank account with the Fed, less the reverse repo program, which is the money market funds lending money to the Fed, and plus the bank term funding program, which is the rescue fund for the failing regional banks from last year. So when this overall liquidity goes up, it tends to be bullish for risk assets because this means there's excess liquidity flowing into the market, bidding prices up. And when this liquidity measure goes down, it tends to weigh on risk asset pricing. And as you can see that throughout the end of 2023 to first half of 2024, both the liquidity and SPY went up together and it came down in the summer. But since the second half of 2024, since the summer, the two have decoupled. So there have been other factors at work outside the Fed liquidity that are impacting or driving the stock market. And in the past, so since the beginning of October, the Fed liquidity has gone up slightly from 5.8 trillion to now just around 6 trillion. But it's not been a sharp rise. It's been quite steady in the past week or so as well. So we are going to look into the other factors that could drive the stock market. Similarly, higher Fed liquidity should be positive for the bond prices, which means yields should come down. So the cost of borrowing should come down when there's higher liquidity. And you can see this is a roughly inverse relationship between the two, the Fed liquidity in the red line and the 10-year Treasury yield in the green line. But I think in the past couple of weeks, again, the 10-year bond yield has risen sharply, essentially since the FOMC has just been on a straight up trajectory, whereas liquidity first dropped and then now rebounded, and it seems not to really have impacted the yields as much. So what could be driving the risk assets? Well, I think the carry trade is not dead yet. So we saw the carry trade unwind in July, between July and August. This is the August 5th crash, where QQQ built a near-term low. And the green line is the US versus Japan 10-year bond yield spread. So when the green line goes down, it means the US bond yield relative to Japanese bond yield has come down. And when it goes up, it means the US bond yield has increased more than the Japanese bond yield. And the theory is that when the spread goes up, then there is a better opportunity for carry traders to borrow at a low cost in Japan, at 1%, for example, and then invest in US treasuries at, for example, 4%, or even equities, which are riskier assets but with higher returns. So generally speaking, a smaller spread puts pressure on this carry trade, and therefore would cause the carry traders to unwind, and that would put a downward pressure on the risk assets such as QQQ. So at the beginning of August, I think JP Morgan said 75% of the global carry trades have been unwound, which could be true. But it seems that since then, as the 10-year Treasury bond spread went up versus between Japan, US and Japan, risk assets have also gone up, which explains the missing puzzle, missing piece of the puzzle from the Fed liquidity. So if you look at the way that QQQ and this bond spread has moved, they're almost in lockstep. When the bond spread goes down, QQQ has been down. When the spread went up, QQQ has gone up. So there's pretty strong correlated moves. So I think, so at the moment, 10-year bond yield, we're going to look at TLT in a second, has been on a very strong move up. I do feel it has exhausted this initial move. So it's due a pullback. And indeed, we have a trace up for that. So that could put QQQ on a small pullback in the near term. And just looking at the FOMC pricing, what we have seen is that actually the market has priced away a lot of cuts since the FOMC. It almost seems that the market has decided the Fed made the wrong move, right? So the Fed was pressured to cut 50 basis points because the market forecasted a very gloomy outlook for the economy, worried about the recession given the rising unemployment rates. But since then, the terminal rate the market has put in has gone up by almost 70 basis points. So if you look at the pricing now, we're projecting the Fed to, the market is projecting the Fed to stop cutting rates at just below 3.5%. This was at 2.75% just a month ago. And if you look at the way that the meetings are being priced, 25 basis points in November, but actually only a 60% chance of a 25 basis point cut in December, another cut in January, and then another 40% chance of a cut in March. So essentially, instead of having 4 straight cuts that the market initially expected, the market thinks the Fed will skip one of those meetings and just deliver 3 cuts out of the 4 meetings. And beyond that, actually, the market thinks the Fed will just cut a couple of more times and stopping at below 3.5%. So this is a much more a very different outlook to what we had just a month ago. Why? I think there are a few components to this. First, the economic data have surprised to the upside. So unemployment rate actually dropped by 0.2% since the very gloomy outlook in the August non-farm payrolls. But apart from that near-term outlook, I think the market is also pricing in a risk of Trump winning, where Trump is now seen as having a massive lead over Harris, and his tariffs can bring in medium to longer term inflation rates. And also, if you look at this chart here, the inflation expectation has been rising. So the inflation expectation is the green line here. Is measured using the 5-year break-even rate. So it is what the market is pricing to adjust for the difference between nominal bond yield and real bond yield. So that has been rising sharply since mid-September, even before the FOMC. And it's been rising with oil prices up until early October. And that inflation expectation has driven the 10-year bond yield up as well. So if you look at the relationship between the inflation expectation and 10-year yield, it's basically moving in lockstep, right? So right now, the oil has topped in the short term here. It's actually calmed down quite a lot. But inflation expectation and 10-year bond yield is still moving up. So I think as we move towards the election, the Middle East conflict and the impact of that on the oil price has actually receded. And the oil picture has also receded in terms of its impact on future inflation. What the market is really worried should be the potential tariffs plans for if Trump wins. So largely speaking, if Trump wins, we're going to get tax cuts, which are bullish for earnings per share for the stocks, but compensated by higher tariffs, which is bad for inflation, essentially. Do I think Trump will follow through on it? I think he wants to. Like, he's mentioned this quite clearly and many times in his campaign. It's a central thesis of his campaign. I don't think it's just all empty threats. And actually, the more realistic those threats look, the better it will work without actually imposing the tariffs. So first, I wouldn't discount everything he says about tariffs as just empty words. But secondly, the contradiction is that Trump really wants low interest rates when he takes over the office, and his tariffs will be at odds with inflation picture, and therefore the low interest rates that he wants. So the market could actually force his hand and throw a tantrum, for example, forcing yields to spike if he really wants to follow through on it. And that will be a massive negative on life insurance companies, pension funds, banks, because those longer term bonds would drop massively in value, as we had before with the original banking crisis. And that could force him to retreat from his tariffs plans. So I think he's not, I don't think he's throwing empty threats, but I think there's a backstop when it does happen. And the backstop will be triggered by the markets. So having said all of that, let's go into the TradingView technical analysis on the market prices. SPY has shown, both SPY and QQQ have shown quite strong intra-month trends since May, essentially. And what I mean is that there's a rising trend through the month, and at the end of the month or at the beginning of the month, this seems to be a sharp pullback at the investors' reposition. You can see that, of course, in July going into August crash, and also September. But even at the end of September, we had a stalling and a shallow pullback into the beginning of October. So I think we're seeing that effect playing out again as we enter the final week of October. Investors are either taking gains or just repositioning themselves into the election. So I think the risk sentiment is not so strong right now. But am I bearish? Absolutely not. I think going past the election, I think no matter who wins, really, we should get a year-end rally as the uncertainty of election gets removed. So there's an argument that Harris will be bad for stock earnings because she plans on raising higher taxes. But actually, I think she has been quite muted on the unrealized capital gains tax. And she may not actually push through everything Biden has tabled. And Trump, I think everyone expects a massive risk-on rally after he wins because of deregulation, etc. But the market has priced in a lot of that already, given the recent move up and also the bond market moves. So maybe I think we will get a rally from removing the uncertainty of election, but I don't really think that one of them is going to be massively more favorable to equities than the other in terms of the risk, year-end risk. I think when it comes to the actual implementation next year, it could make a difference, but we will navigate that as we approach it. So I think towards the year end, we should get past 600. It's really interesting that we're at the all-time high, essentially, and everyone is nervous. Everyone's trying to call the top. Everyone says nothing is sustainable, etc. And that's a really good thing, actually, for equities, because equities tend to climb higher when everyone's discounting the positive prospects. And secondly, this bull market is very young. It's only been 2 years. And historically speaking, this will be one of the shortest bull market if we topped today. Just bear that in mind that in a bull market, there tends to be a lot more momentum, and bull markets last way longer than bear markets on average. So I would position myself bullishly going into the election and going to the year end. And I think the global easing cycle could also have an impact, a positive impact on equities pricing going to year end next year. And I will show a chart for that when we talk about gold and Bitcoin. QQQ, again, I think QQQ has not broken the all-time high. A lot of investors has rotated away from tech heavy sectors into other areas, but I think it's just a matter of time before we get above it. So I'm very bullish. I think towards the year end we can get towards 550, 560. And of course, those projections are rough estimates, but I just to emphasize, my view is medium term up. TLT. So I do admit that TLT did catch me by surprise a little bit because I did think that we could have bottomed here, and we did get a bounce, but that bounce was actually short-lived, and we got a lower low. And so this structure from the pre-FOMC high to here is actually a 5-wave down, and which means the bears are in control. And what that also implies is that the next bounce here is likely to be a 3-wave bounce, which would be a B wave. And the B wave could retrace anywhere between 50 to 78% of this A wave. So I'm just placeholding here. We just have to, and it's really hard to trade this if you want to play it short term. So we have a live trade set up with the stock way lower. So I would just not do anything. I would just watch. We also have a hedge against high inflation and therefore lower TLT prices through the USO trade. The only downside, and I would caveat that hedge, is that Trump has wanted, so if Trump wins, he wants to reduce inflation via lower oil prices through higher production in the US. And US is the leading oil producer now. And in that case, we could have high inflation through tariffs, but actually lower oil prices through high US production. And we could lose on both legs of this hedge, the bonds and the USO, if that does happen. So that is a scenario I'm watching. We're really early in this narrative at the moment, so I'm not too worried about it yet. But that I just want to highlight the potential pitfall of our pair trade. Okay, so I'm now going to move on to Tesla. So Tesla reported earnings on Wednesday evening. Missed by revenue, but doesn't matter. Earnings massively outperformed. And this is because Tesla has really got its cost disciplines up and expanding margins across gross margins, operating margins, EBITDA margin, and free cash flows. So, I think that going into the earning, the market was pretty pessimistic. So for nearly 10 days, the market just wouldn't budge either up or down. And you can see all of those very short doji candles printed here. So they look like a very short cross with very small body. And it really signals that the market was undecided on what they should do. So I think, but because it was resting on this VWAP, so there was a lot of support in this region. Volume profile from this low. You can see that in the 220 area, a lot of positions were being built. And actually, if the earnings disappointed, it could have quickly slipped all the way down to somewhere like 180 to 190 region. So this is why it's really important to have a stop, even if you are bullish with your setup, because there's always a risk that the supports, that whatever supports you have didn't work out, and then you things travel, the trade breaks, the setup breaks, and the price action travels down really quickly, and actually the climb back up will be very difficult. So, my plan going to the earning was that if it does fall below here, I'll just stay out of the way and let the market resolve itself before I buy back in. But I think this, because the bearish sentiment almost reached a maximum level going down here, we had a really sharp bounce after the earnings. And the way I think about Tesla is that if you value Tesla as a car company like Ford or GM, the stock market, as the stock price should really be worth about 1/3 of its current market price. So, i.e., $80 per share. What Tesla shareholders are really betting on is the autonomous future with the robotaxi planning out, and Tesla being the leader in that category and controlling the economics. So, for example, Uber takes home, let's say, 20 to 30% of the income of the drivers. The robotaxi could take home 56% or maybe 50%, which is much higher margin from the fleet owners, for example. And of course, we're in very early days. But the thing about Tesla is that the great majority of the cars that are already built have the autonomous capability. They just look like normal cars. So it's not just that the Tesla Cybercab or the Robovan that are actually autonomous. The average Tesla car is autonomous already and have capabilities, and they could do software updates to switch on fully autonomous driving and robotaxi capabilities when they get regulatory approval. The regulatory hurdle is probably a big one. I think they could get approved quite quickly in Texas, but I think California might be much trickier. California is a bit hostile to Elon Musk, not just in terms of approving the Tesla stuff, but also SpaceX stuff as well. And I think that's probably one part of the reason why Elon Musk is supporting Trump, because he doesn't get really any favors from the current administration anyway. He might as well bet on a new winner who he can lean on if Trump wins. So that's my thesis. Technically speaking, we have overhead resistance here, and if you just extend further left here, this area here, so 260 to 280 region, has been basically a big area of resistance. And if you look at classical analysis, you have the head and shoulders here, and this is almost the neckline. So once we break above it, I think we can go up and retest, and up we go. And that the speed of travel could be quite quick. But I think getting through this resistance will probably require a couple of attempts. So what I think is that we try to break above this, get a little pullback, and we get past it to get to the 300 level, a big psychological level at 300, a retest and up. Of course, I will never get the very short-term volatilities spot on as always. This is extremely difficult to predict. But I think the point I'm trying to make is that once we get past this resistance, the next levels, the long and medium term is looking up. And in the very long term, I do think Tesla is going to want to try to complete this 5 waves up to finish above around 1,000 level to finish this entire cycle. And that could be after suburb cabs coming to mass production or robo-taxis really take off. Musk has been light on his plans on how exactly the ride-hailing services would work, but I think the market, but I think the price always travel ahead of fundamentals. And also there's a lot of I think Tesla basically trades more on macro and technicals rather than stock fundamentals anyway. If you just look at the fundamentals valuation, the valuation is just really not justified given its growth rate, etc. It's really about this future narrative that Musk is trying to build, and I think it's pointless trying to be really rationalizing. Okay, what should the fundamentals? How far above the fundamentals the stock should be doing. Right, what we really should do is just trying to gauge the market pricing of Tesla and follow the market's lead, and using our technical analysis, but also the greater macro tools we have to help trade this stock. And so this comes to my point about Tesla and macro. So if we look at the 2-year and 10-year bond rate, so 10-year is this purple line here and 2 years the red line here, versus Tesla. When bond yields start going up, actually, that's exactly when Tesla topped, right? This is the region I pointed out just now. That is the overhead resistance. And as the bond yield topped in April this year, right, just around those a couple of weeks, Tesla bottomed. So you can see that Tesla stock is quite, and obviously, of course, you had earnings as well. But I think if you just look at the general direction of travel, is almost perfectly inverted from the bond yields. And over here, you have the carry trade unwind, but that falling down. But I think if you just look at this April to September direction, that's an upward move from 140 to nearly double, while bond yields fell essentially from the 2-year fell from 5% to now 3.5% at the end of September. So this is a quite correlated move. And actually, if you look at the price action from September, as bond yields rose again after FOMC, Tesla fell again, right? So if the bond yields start falling and falling from here, retreating from here, and I think in the short term we will get a bounce in the TLT, and this move does look quite, it's not extended, but it looks full. We could help Tesla getting above this resistance essentially. But if this bond yield still remain very high, then in the near term, Tesla could have consolidate and try to digest, and it may struggle to break above this this resistance. So I think the macro, we just have to consider the macro conditions as well. And then the final thing is, of course, the election. Elon is very supportive of Trump. So for most investors, it sounds counterintuitive because the Biden administration seems to be more sustainability-driven, policy-driven than Trump. But perhaps so apart from the regulatory approval stuff I mentioned about the FSD, maybe Elon also thinks that whatever Trump does, it could hurt his rivals much worse than Tesla, because Tesla is essentially profitable now with the mass production of electric vehicles, whereas other car companies still aren't. And that could actually, unfavorable regulatory policies, unfavorable federal policies towards EVs may actually hurt his rivals more. That would be a cynical approach. Of course, I don't have a phone line with Elon, but these are my guesses, right? I think he's a businessman ultimately. He's the richest guy in the world. Of course, he says he's not money driven, but of course he is. We just want to follow the incentives to see where things can take us in terms of the Tesla stock. All right, so moving on to the next Mag 7 stock, Apple. I think we are moving towards wave 3 now. And actually, apparently in China, this demand for iPhone 16 has been higher than expected, 20% higher than iPhone 15 when it first launched. So that starts to look positive. And I think the catalyst really is towards the year end when they start releasing the Apple Intelligence software. And that would really make a huge difference on the iPhone capabilities. And I think that could act as the catalyst for the stock. And of course, as the general risk on sentiment after towards the year end. So I think if we were to trade this, I really don't mind playing so let's say entering today. If we put 1, 2, so wave 3 is at 1.382 extension, and I've got wave 5 at just around 2 extension of this wave 2. So I think we can place it, maybe not 310, but 300, 305. I think we could get there in early next year. And I would put a stop. I think if you are, I think we can put a stop here. That's quite tight. I would put it just below this VWAP from the May low, or even this red line, because that's supported this drawdown here. So I think that still offers quite good risk reward, 3 to 1 here. Getting below this, the action is probably not very price action, probably not very supportive. We get some, we could get some support over here, just below this wave B. But I would have to reassess this chart essentially. So that would be my how I would play this chart for Apple. Amazon, I think Amazon looks very similar in terms of this setup. It's not quite managed to break above 200 yet. But if we were to do a trade here, it's very similar to the Apple setup. We can play either wave 3 or wave 4 here, wave 5 here. And I'll place a stop probably at this wave 2 low here. So essentially, we're playing the 5 waves of this bracket wave 3, and that still offers 3 to 1 risk reward. So that's pretty nice as well. Google, not much to update since last week actually. So if you look at, so this is the VWAP from September low, and this is the VWAP from July high, and it's just basically the price action is being range bound between those two VWAPs. It's tried to break above this July VWAP, it's not succeeded, and it's tried to break below, it's not succeeded, and it's caught right here now. So this just means almost the entire market since July is essentially at a break-even point now, right? Going below here, then people are back holding, and they probably will sell when it bounces. And going above here, we're really taking off because everyone's essentially in profit. The pressure for selling is quite low. So this becomes a break-even demand point. This is where people on average has bought in. Do I think this will have this C level play out? I think I'm not going to remove this possibility just because this B wave hasn't gone above wave 1. So to convince me otherwise, I really want to see Google break above this wave 1, essentially break above this VWAP, and then I can put on trade for wave 3. Right now, I don't think we need to do anything, and we can just sit and watch and let the market decide what they want to do. Meta, and actually Meta, I would enter around 540 region. And the setup essentially is this. If we go for this wave circle for low, we can target this wave 5, and we can put stop below here. But or you can put on a larger degree wave 5, which is 30%. And you can put a stop here, and the stop here will essentially be just above this empty volume profile here. So I think once it breaks above this area where it's mostly traded, price could fall much more quickly. It's a pretty bullish stock, generally speaking, so it's quite hard to catch a bigger pullback than this. So even though the risk, the upside doesn't seem that great compared to the other setups, it has been a pretty solid name in terms of momentum, which is why I don't mind playing this if it gets to that level. Or if you're even more cautious, we can just move it here to this red offset here. So this red offset just means it's 3% below the VWAP, and that's historically supported the price. And it's also a region of most traded volume. So that should provide some support, good support for the price action and give us a better risk reward essentially for this trade. Microsoft, what we've had is an A, B, and we're now trying to finish C. And we also have finished A, B over here. So we're just in the very final leg of wave circle C of 5, right? And I expect a very big correction after that. And right now, this is also a very heavily supported region, where the VWAP has, from the August low, has supported the price action so far, and we're above the volume traded profile here. So most of the transactions are on here, and on average, the market is in profit. So the headwinds essentially is much lower now. How do we get from this wave below to essentially finishing at this wave C? I think we're too early to say how this final structure plays out. I just need more data and evidence to see what the final structure becomes. Okay, if we're entering now, we have a wave B. We have a wave B low here as a stop, and then aiming for much higher. 45, that's pretty nice. But I just don't know how this final wave will play out eventually because we don't have enough price action yet. NVDA, I think we can essentially remove this red alternative now. And we've just cleared that all-time high, previous all-time high here in June. So I do think the market is poised to rise higher, and the wave 3 target is 180. We possibly could get there before the year end, but I think the final wave 5 around 215 won't be reached until next year. This wave 4 pullback could be shallow, but just looking at the whole structure of the entire move from the October 2022 low, it's been pretty nice range-bound channel here, right? Every time we approach this upper hand, we were dropping back, or consolidating rather. And as we approach this lower bound, we are bouncing off. So I think the price action should largely stay within this channel. It could go up to here and stay in the lower side of this channel, but I am bullish now, given the latest price action. Now I think it's really important that we follow the price action with our view. We shouldn't be stuck around thinking, okay, because I said it should have an ABC move down, I'm just going to insist on that. We let the market tell us what the market wants to do, and we interpret that within the larger context of macro, technical setup, a Fed, valuations, etc. CRM, really not that much going on here. Is basically essentially it's consolidated in the past 2 weeks, not really moving up. It still looks like an ABC here, so it doesn't look decidedly bullish. So, of course, if it breaks above this wave 5 high, then this will just be a 1-2 setup, and we're going higher, and that will change this out. But right now, I think it could retest at least this VWAP here, and the wave C will be a 170 region, and that will be a very attractive price to enter. How would it get that in terms of narrative? Salesforce is really focused on its agent force. So essentially AI agent, like very sophisticated workflow chatbot assistant type of thing for customers. If we don't get enough demand for it, reception is not as bullish as what the CEO has claimed, then we could get a correction in the price after the next 2 quarters. But right now, the overall trend has been up. I just want this Salesforce to clear this wave 5 high before I get decidedly bullish on it. ADBE, this is a company that grows 10% a year. It has a pretty good moat. But the strange thing is it has not cleared. It's still way below its all-time high. I'm saying the all-time high is actually here. It's still actually way below its 2024 high, so 52-week high. It's the second or third largest company that is 20% below its 52-week high. What I said last webinar was that I want to enter the trade when it gets above this green line here. So this is very, remember the Google chart earlier. What we had is that this is the VWAP from the September high, and this is the VWAP from all the way from the October 2022 low, and that has been extremely supportive of the price action. It's been tested 1, 2, 3, 4, 5 times now, and every time this red line has stood, and this red line essentially is 5.5% lower than the VWAP. So that is the sort of loss tolerance investors have below the break-even price since the October 2022 low. Now we're approaching the VWAP, right? And last week I said, I want the market to show us a bullish trajectory first before we enter. And then we can use this low as a stop. The market has not given us that. Instead, what we've had is a C wave correction. So the way I would play this is once it reaches this VWAP, I could enter here and have a stop just below this red line. And then I would want to probably aim for this wave 3 high near 710 region. So if it breaks below this, I just have to reassess the entire chart, because what we could have is that I've just had 3 waves up, and actually this wave 4 is just essentially a B, C, a much wider flat for this wave 4. And we essentially don't want to catch a knife there. Let me know in the chat if it doesn't make sense and you need more questions, but we will go through this setup a bit more when it reaches this VWAP of 468 level. Netflix, very positive earnings, as I mentioned last time. Not much going on, really. I think the wave 3 move is mostly done, so I'm just waiting for a pullback around here. This pullback, this wave 4 might not be very deep because this wave 2 was quite deep. So proportionally speaking, a steep wave 2 usually results in a fairly shallow wave 4. So we can have wave 3 here, and then wave 4 typically at this level, but I think for next Netflix, we could just be around just under 650, and then we can finish higher at 960. So that would be a quite nice setup here if we get that pullback. And I'll put it again, probably just around here, where this volume traded level for support, and this red line as the VWAP offset from the January high, so from the beginning of the year. So nothing to do for now. The Citibank, we cover this this week. It looks like it's in the final stage of the C wave of wave 5. And this will mark the cycle finish from 2008. The near-term 2024 price action has been pretty good, very bullish. It's tested this VWAP from the November low just once, and it stood. And that's why I think it's a wave B low. We have a trade setup here, and I think the wave C could end above 100. Just conservatively, we're just going to take profit at 100 because that's a big psychological level. And if it breaks below this red line here, then price could travel much more quickly down to below 50. And we essentially want to get out of the way if that happens. Gold, wave 5, I think we're now approaching wave 5 or 5, where the termination area is 255. It's just want to show you how this happens. So wave 1, place a wave 2 low. Wave 3 is a very typical 1.618 reach extension, and then pullback 1.236, quite shallow pullback because this wave 2 was quite steep. Wave 4 tends to be shallow, as I mentioned earlier. And then now the target area is at 255, which is 2 extension of wave 1. I think since we started this service, I've been less bullish on gold. I think I am very bullish on gold longer term because I think we have, after that, we still have a wave 4 correction and then wave 5 runaway towards the 234, 270 region, or even higher actually. And that final leg should be retail participation, which hasn't really happened yet. But I think so since the service started, when I started looking at this chart, I did feel that gold was quite full in terms of wave 3. So I did think that we probably had wave 3 high here, and then wave 4 could be much lower before it goes up. But actually, gold has been just on a tear. So apologies for misjudging how high gold goes, but we did do a very nice catch-up trade on silver, which has now stopped. So we did bank a quite decent gain on silver. We entered, I think, around this level 26, and we exited around 31. So that's pretty nice. What I think is that I think the run is, we have near-term resistance. Essentially, the 5 waves can now kind of complete. It could stretch to 32, all right? We could have this final leg stretching to 32, but that's not much higher than now. And actually, pre-market, we're traveling at 30. So we've exited the trade, which is nice. I'm just going to wait for essentially the ABC correction for this wave four, a large degree wave four, to play out. So now moving on to Bitcoin. Well, I think we're still in this wave C, and I think this wave C should complete definitely above 770, but more towards 73 level. And essentially, we should essentially match the all-time high here. And that would really complete the comeback from the March dip. And on a smaller degree, I think we had a wave 1, 2 here. And what we had recently, the pullback, is a wave 3 and 4. And that's been quite a standard pullback, reaching just between 1382 and 1618 extension. Now we're pulled back to 64K very, very quickly. And the next wave up is really 73K. And after that, I think we will have a B wave pullback and then fully take off above all-time high. And I think a lot of investors, so I think recently investors have started rushing in. So IBIT, the BlackRock iShare ETF, has seen a lot of fund flows in the past week. But I think the participation is not as wide as a bull market would suggest. I think a lot of people still feel like this move is quite extended already, now meeting resistance, and they want to catch a bigger pullback before they enter, or they're still skeptical that Bitcoin can break above the all-time high. And I think that's actually pretty healthy, because if we are already feverish, with everyone thinking Bitcoin will get to 100K already, then this move probably wouldn't actually last very long. But because we still have a large trading population being skeptical or being afraid to front run this move higher, it means there's a lot of legs left. And we will see much more positive headlines about Bitcoin once we get to this region here, and then there it's going to be a blow off top. And I do actually think this wave C target can be conservative, and this wave B pullback may not be that steep. And this is the chart I want to show you now. So the blue line here is the M2 minus broad money supply of US, China, Europe, Japan, and UK in dollar amounts. And the yellow line here is Bitcoin. And if you just look at how the M2 levels change month to month, and these are monthly data, versus Bitcoin obviously overshot here, but in terms of directional moves, they're very correlated, very interlinked. And it seems that the Bitcoin actually didn't move as much as people expected into the October 2021 high. That's when we had a bear market. But the global liquidity has broken to an all-time high since July, actually. And Bitcoin hasn't. Bitcoin is still hovering at this, it's basically stagnated and hovering at this all-time high here. And so actually, I think we are due to break out soon. I'm not talking about tomorrow, I'm talking about next 2 months into the new year. And I think that leg up could play quite quickly. And if you just look at the relative levels, I think 100K is a conservative. We could easily get to 120 in the next leg up. But we will approach that structure as it comes. Ethereum hasn't quite reached this overhead resistance yet. It's still a little bit of a struggle. It hasn't even cleared wave A. So still has some way to go. And I think Bitcoin has been the front runner in this move. And I think the altcoin, Ethereum and other altcoins will need to catch up, a bit like gold and silver. So it's resting on the VWAP. So and it hasn't broken below yet. I would say not much to do until there's a breakout either direction. I do think wave 4 low is in place, so we should really try to clear this wave 1, here, and wave 1 target here at 3,000. Get a pullback, and then wave 3 above 4,000 or even 4,500. Coinbase is a halfway house between Bitcoin and Ether. So I think when Bitcoin goes up, Coinbase tends to overshoot and actually overperform. But when we're in a bear market or when Bitcoin retreats with Ethereum, Coinbase also then underperforms, undershoots as well, gets dragged down by Ether. So I do think it's quite a good proxy for the crypto move. And if you think about, yes, we have Bitcoin ETF, and we have the Ether ETF. But a lot of funds are not mandated to play ETFs. They have to buy stocks only. And Bitcoin miners are actually notoriously volatile and difficult to trade with very poor economics. And the reason there is poor economics is because miners do not command either the input cost, which is electricity, or the output cost, the product cost, which is Bitcoin, which makes their jobs quite tricky. So you've seen that MicroStrategy has gone up quite a lot significantly. It has really front-run the Bitcoin move because funds who cannot invest in ETFs or Bitcoin directly are trying to avoid miners and therefore pile into MicroStrategy even at a high premium. And I think because now the MicroStrategy premium is so high, funds probably would favor Coinbase as the next proxy to invest for the crypto move. So we had a really sharp move off this September low, where you have a trace up entering around 165 and mid 160s. We've benefited from that move. And I think what we had is an ABC move higher. We should get a little retrace here and before we finish this wave A. And historically speaking, if you look at the previous moves, those happened within essentially 2 or 3 months each time, February to March. My worry is that if we want to really stay out of the market and being hesitant, we actually might miss this move higher because it can travel quite quickly. And so I wouldn't be that regimented about whether this C leg with C downside will play out. I'm staying invested, and actually in the next pullback, I will just add anywhere below 200 really, rather than trying to pick the absolute bottom. And I think the move up could happen much faster than average trader or average market participant could expect. And the pressure is really on the upside. So the first level to clear is this VWAP here at 215, which has been breached a few times before. So this is not like as a strong resistance level as before, but there has been a lot of volume profile built between 200 and 225. So once we get above this, I think the game is over. We're just basically getting towards 300. So I'm less conservative with adding coin. Any questions, feel free to ask me in the chat, and we'll speak soon. Thank you.